The top business stories live from the Sky News City studio. A persistent under-delivery of new homes. The competition watchdog blames a complex and unpredictable planning system. More signs that the labour market is cooling, with employers advertising the fewest jobs in nearly 3 years. Plus, distribution giant Bunzl snaps up the catering equipment supply in Nisbets. I'll be joined by Bunzl's chief executive. Good morning. This is Business Live with me, Ian King. The UK competition watchdog has launched an investigation into 8 of Britain's biggest house builders after finding evidence they may be sharing commercially sensitive information. The Competition and Markets Authority did so after completing a year-long study into why Britain builds too few homes. The regulator concluded that the house building sector needs significant intervention due mainly to what it described as a complex and unpredictable planning system. Well, joining me now is Sarah Cardell. She's Chief Executive of the Competition and Markets Authority. Sarah, good morning to you. Before we go on to the main thrust of the report, you're investigating suspected exchanges of sensitive information by 8 house builders. What more can you say on this, please?
Yeah, so it's important to say that we don't see this as the sort of key driver of the fundamental issues in the market. I'm sure we'll come on to talk about those. But during the course of our market study, we have seen evidence of suspected exchange of commercially sensitive information, for example, in relation to sales prices, sales rates, incentives offered to new home buyers. And it's obviously critically important that we get to the bottom of whether there has been a breach of competition law. So today, as part of our announcement, we are launching a new Competition Act investigation to look into that further.
And how long do you anticipate that taking?
So we need to conduct our inquiries, work with the companies under investigation to get to the bottom of what's been happening here, and then we will be able to provide a further update in due course.
Would this suspected exchange of information have been taking place locally or nationally?
So those are the kind of things that we need to look into further. And it's really important, I think, to emphasise, though, that this is just one element of the report that we've published today. Actually, what we've done today is complete a year-long inquiry looking fundamentally at what's driving the poor outcomes in the house building market. We've seen a need for really significant intervention to deliver a greater number of new homes across England, Scotland and Wales. And our key concerns there really are much more about problems that we've identified, particularly in relation to planning, also inherent limitations in the number of new homes that can be delivered through private development of new homes, and some really poor outcomes also for new homeowners, particularly in relation to private estate management charges and some concerns about the quality of new builds and the ability of new homeowners to get redress when quality issues arise. So a broad range of issues. The Competition Act investigation, very much just one part of that.
What makes the planning system so unpredictable?
So it is a really complex area, and I think it's important to emphasise that in our report we are putting forward a range of proposals for governments, UK government, but also the Scottish and the Welsh government to consider here, because we recognise that this is a complex policy area where there are important trade-offs at play. But what we've seen is a system that is lengthy, it's costly, it's unpredictable and it's complex, and that is not delivering the number of planning applications that are needed to support the housing need that we see. There's a huge shortfall here that we see year on year. So we've set out a range of proposals, things that can increase more effective use of targets, better use of local plans, more effective monitoring and enforcement of those local plans, improvements in the way the consultation process works, perhaps a reduction in the number of consultees involved in that process, and better protection for planning fees as well, to make sure that planning departments are actually well funded and able to process those planning applications.
Now, the house building sector is regularly accused of so-called land banking, the stockpiling of land to restrict supply and keep prices high. You haven't found evidence of that?
So we've looked carefully at this issue and we have seen reasonably high levels of land banks, but this really is a symptom of the problems in the planning system rather than a cause of the underlying problems in the market. So our expectation is if you improve the planning system, you will see a reduction in the level of land banks held by the major house builders.
And very briefly, Sarah, if you would please, one of your recommendations is that councils are obliged to adopt amenities on all new council estates. Why isn't that happening at present?
So what we've seen at the moment is an increasing trend to private management companies running these amenities. We're talking about things like roads, sewers, public spaces, and homeowners are left footing the bill, often high and unpredictable charges, poor management of these services. And you're right, we recommended that going forward, those public services are adopted by local councils. We've also recommended that for homeowners who are subject to private management charges, that needs to be much better managed in terms of improved consumer protection and better enforcement of those consumer protections.
OK, Sarah, we have to leave it there. Thanks very much indeed for joining me this morning. It's appreciated.
Thank you very much.
Some other business news stories for you now. And the French company hoping to buy Wincanton raised its takeover bid for the trucking and logistics firm this morning to £647 million. The increased offer from Sever Logistics, whose parent company is based in Marseille, came as Wincanton said it had received a rival takeover approach from an unnamed party. But I can tell you in the last few minutes, my colleague Mark Glyman has named that unnamed party as the privately owned Clipper Logistics. His report is on the Sky News website right now. Sever had originally agreed to pay £566.9 million when a deal was first announced last month. Shares of Wincanton, which employs 20,000 people in more than 200 sites across the UK and Ireland, and whose customers include Asda, Weetabix and Heineken, was surged by 11%. Shares of Bank of England have fallen by 9% this morning after Ireland's biggest lender sharply increased the sum it set aside to cover loans it does not now expect to be repaid in full. The bank announced an impairment charge of €403 million for 2023. That was up from one of €187 million in 2022, which it said was mainly to address potential risks in its commercial property loan book. That revelation took the shine off news that Bank of Ireland made a pre-tax profit of €1.9 billion during the year, up from one of just over €1 billion in 2022. And tomorrow afternoon, I'll be joined in the studio here by Miles O'Grady, Bank of Ireland's Chief Executive. And French building materials giant Saint-Gobain is buying Australian rival CSR for $4.5 billion Australian dollars. That's £2.3 billion. Saint-Gobain, the world's biggest glass maker and whose brands include the plasterboard manufacturer British Gypsum, said the deal was a unique opportunity for it to establish a leading presence in the Australian construction market. It said it was also a decisive step towards strengthening its presence in the fast-growing regions in Asia-Pacific. Now, the number of job vacancies in the UK economy fell by almost 15% last month, according to the latest monthly jobs report from Adzuna, the jobs search engine. It found that the number of job vacancies in January fell below 900,000 for the first time since April 2021. Well, every single one of the 26 sectors Adzuna tracks experienced a monthly fall in hiring over January. Well, joining me now is Andrew Hunter. He's co-founder of Adzuna and author of the report. Andrew, welcome to you. I mean, employers are clearly put hiring decisions on hold. What do you put that down to?
Good morning, Ian. Yes, January is typically the 1 month of the year where you expect to see that hiring surge. If I look back at Adzuna's data for the last 10 years, that's what we've seen. This year has been different. And I think I've said on your program before that companies are holding back because of wider uncertainty in the economy, but also this increasing of costs of goods and services, borrowing being more expensive, is driving businesses up and down the country to think very carefully about their hiring budgets and who they go out and advertise to hire for in the future.
Interesting to note that they're also taking longer when filling vacancies.
Yes, that's right. So the time to hire is a key metric that we track on our platform, and that's at a 3-year high of over 36 days. So I think that's that thoughtfulness from the employers coming through, because I think they're making the decisions as to whether they train and upskill existing employers or go out to market and see what they can get. I'm really happy that Adzuna's job market data is piped directly into the Bank of England as one of the many economic indicators they use, because I think the cooling of the job market will likely fuel hopes of an interest rate cut sooner rather than later.
I'm sure it will. I mean, one thing that is really interesting to me is that the number of job seekers per vacancy is at the highest level since August 2021, and yet wages are still rising. Economists wouldn't necessarily expect to see that. Yes,
it's quite unusual to see wage growth, and we're definitely seeing that on the Adzuna platform. So about 3% wage growth year on year. The ONS are saying 6%, but you have job stock shrinking at the same time. So this unusual predicament of wage growth but job creation stagnation creates a bit of a headache for Andrew Bailey and the Bank of England as to what to do with interest rates.
Quite interesting to see just where wages are rising most rapidly. It looks like the East Midlands is a bit of a hot spot just now.
That's right. I think the Midlands, the North East and Scotland are playing catch up. If you look back to 2023, those were some of the hardest hit areas when it came to wage stagnation. So it's good to see those areas catching up. And of course, in April, we're going to see the national living wage rise from £10.42 to £11.44. So that's a 10% pay bump for millions of workers up and down the country. So wages are on the up. Do we have enough data to see if inflation is corrected and interest rates can start to come down? Let's see.
Do you think that rise in the living wage will have an impact on hiring intentions?
I think that will flow through to the numbers. I think it will further increase the cost of running a business in Britain in 2024. So, I think employers need to see tax breaks. They need to see a drop in the costs of goods and services to really take the lid off the hiring cap that's currently on. So there's a lot of mixed economic signals out there. And I think perhaps most importantly is general sentiment. There's a budget coming up in about 10 days' time. The mood music in that budget is going to be hugely important to whether employers have that confidence to really scale up hiring efforts in 2024.
OK, Andrew, got to leave it there, I'm afraid. Thanks very much indeed for joining me again. Good to see you again.
You too.
Well, Friday evening strong showing on Wall Street, during which the S&P 500 and Dow Jones Industrial Average closed at new record highs, was followed by a mixed session for equities overnight in the Asia-Pacific region. The Nikkei in Tokyo hit another record high, but there were declines in both Hong Kong and Shanghai. Well, in Europe this morning, stocks are trading in mixed territory here. Talking points today include PostNL, the Dutch postal operator, is off 6.25% in Amsterdam on news that profits this year will be lower than expected. Here in London, the FTSE 100 currently off by around 1/3%. The mining heavyweights are weighing on the index to an extent. The biggest blue chip faller in percentage terms is Ocado. That's on the back of some adverse broker comment. It's got results out later this week. One or two of the house builders, meanwhile, are under pressure on news that the Competition and Markets Authority is investigating them for suspected information sharing. Taylor Wimpey, as you can see, off nearly 4%. Barclay Group off 1.5%. Persimmon also off by around 3.5% just now. Among the blue chip gainers, well, Standard Chartered is up another 2.5% following Friday's results. You recall we had the CEO, Bill Winters, on the programme this time on Friday. Meanwhile, outside the FTSE 100, WAG Payments is up 4.5% on the back of last week's management reshuffle, while Me Group, whose chief executive was on this programme last Thursday afternoon, is up nearly 4% as analysts upgrade their forecast following its results the other day. On the foreign exchange markets, well, it's all pretty flattish, to be honest, ahead of US inflation data later this week. The pound, which last week notched up its best winning streak against the dollar so far this year, up 0.1% right now against the greenback. It's off by a similar amount against the euro. Single currency, meanwhile, up nearly 1/3% against the dollar. As for the oil price, well, that is softer again this morning amid concerns over delays to US interest rate cuts. Barrel of Brent crude currently changing hands at $81.29 a barrel. That's off 0.2%. Who joining me this morning is Russ Mould, Investment Director at AJ Bell. Russ, good to see you this morning. Let's start off with the Nikkei, because, it finally overtook that 1989 record last week, and it's kept on motoring. Why on earth is Japan doing so well right now?
Yeah, it's been a long haul, 34 years to get there. I guess the lessons are there, first of all, on the way down. The bigger the party, the bigger the hangover. So we've all got to be a little bit careful as we fall over ourselves to buy Nvidia stock right now, if that's what we're doing. And ultimately, valuation does matter. The Nikkei got to be sufficiently cheap. The companies a lot of companies have got very strong net cash positions. The market was looking undervalued. And then you finally got a catalyst to change market perception that it was just beyond the pale with the Abenomics reforms which came through, and companies began to focus on better corporate governance and higher shareholder returns. Plus, you've had the Bank of Japan still running negative interest rate policies and still printing yen as part of its quantitative easing program. And that's been a big contributor, that cheap liquidity that's been still pumped into the market.
Now, closer to home, Wincanton, the bid situation there's hotted up this morning. My colleague Mark Kleiman says Clipper Logistics is the other would-be buyer.
Yeah, he's done very well there. That man's got more sources than Delia Smith because they kept that one extremely quiet. So, but the shares are up to an all-time high. I guess what's interesting is the market is now expecting that Clipper will come in with a higher bid than the French option, which has now been upgraded to 480 pence. I mean, even that 480p represents a 62% premium to Wincanton's share price before the first bid came in January. So again, just talking about the Nikkei having been unloved for a very long period of time and value finally coming out. There are still people looking at the UK equity market for all that it is unloved, and maybe the fact that it is unloved means it's undervalued. And there are some nuggets to be had out there.
Now, we were talking just now to Sarah Cardell from the Competition and Markets Authority. What do you make of the broad thrust of her report today?
I mean, I think she took great pains to say that the only thrust is not the information sharing issue. She's looking at much bigger issues, such as this one of local planning, against which the house builders themselves have railed for a very long time. Tony Pidgley and Rob Perrins at Barclay Group have been particularly vocal in that respect. So in some ways, the house builders will probably be quite pleased to feel that they have an ally on their side. Equally, I'm sure they're not thrilled about the idea of a new housing ombudsman or potentially additional regulation and red tape in that respect. And clearly, nobody wants to think that there's been any collusion going on there in terms of site development or pricing. So the market is obviously a little bit nervous. These companies are still dealing with one lot of regulation over cladding remediation. They're dealing with higher mortgage costs. So it's an additional complication for them. And I guess that's why the shares are flat to weaker this morning.
Now, separately, Russ, over the weekend we heard from Berkshire Hathaway and Warren Buffett's gigantic cash pile, but he's got nothing to spend it on.
I mean, first, it's interesting that it was a very downbeat meeting in many ways, partly because of the death of his long-term business partner, Charlie Munger, late last year. And the cover of the Berkshire annual report is black this year to reflect that. But yeah, nearly $200 billion in cash on the balance sheet and a $1 trillion balance sheet overall, including all of its equity investments and operational assets. So Buffett is saying we're so big, we're finding it really hard to find a deal that will move the dial and create the sort of value that we've done in the past. So it may be partly a function of the size of the business. It may also be a function of he could just be having difficulty finding things that he believes are good value. After Munger's training, he no longer tries to find fair businesses at wonderful prices. He looks for wonderful businesses at fair prices. And the fact that he's struggling may mean that he doesn't think there's a lot of to be had out there. And in fact, the business has been selling shares recently, even in Apple, something, again, big fans of the Magnificent Seven may need to ponder.
Yeah, it's a very good point you raised there, Russ. We have to leave it there, I'm afraid. Good to see you this morning. Hope to see you back in the studio next time.
Hope so.
Take care. Still to come here on Business Live, I'll be speaking to Bunzl's chief executive about the company's results and its acquisition today of the catering equipment supplier Nisbets. Don't go away.
I'd logged in and it was, I'd seen there was a win. Didn't look at the date, I just looked at it and there was a £2.60 win there. So I said to Debbie, we've won £2.60. She said, great, let's go and have a bacon butty or something, celebrate. And then later on in the day, another email arrived, exactly the same message. I thought, there's a glitch. And so I logged in again and there's a message there saying you've won £61,708,231 and call this number. And that's how we found out. And then we had, tried to ring and had problems with the phone signal and so on and so on,
Well, there are three bits of advice that we give them initially. The first one doesn't really apply to Debbie and Richard, and that is maintain your anonymity, at least until you've taken professional advice. The second piece of advice is to really just pause and reflect and put the money in a safe place on deposit. And the third thing that's really important is to take professional advice from somebody who's suitably qualified. And in fact, most of the pitfalls seem to emanate from not doing those three things.
OK, well, they haven't done the first thing, have they? They've gone public. Why do people go public?
I can see the benefits in it, because if somebody's won 61 million, then obviously their lifestyle is going to visibly change. So, there is an argument to actually go public and manage it in a better way. But the general principle is that, I mean, there are lots of JAPA winners that don't go public. You know, they maintain their anonymity. I mean, our typical advice is to, you know, maintain your anonymity at least until that initial euphoria has died down and you've had the opportunity to reflect and take professional advice.
It's like Emirates. It's like better. Fly Emirates. Fly better. Thank you.
Welcome back. The FTSE 100 International Distribution and Services Group, Bunzl, has agreed to buy an 80% stake in the catering equipment distributor Nisbets for an additional £339 million. The deal means a big payday for the family of Andrew Nisbet, who found the business, which is based in Avonmouth in Bristol, 40 years ago. Well, the news came as Bunzl, which employs 225,000 people in 31 countries, reported an adjusted pre-tax profit of £853.7 million for 2023, up 4.4% on 2022. Well, joining me now, very pleased to say, is Frank van Zanten, the Chief Executive of Bunzl. Frank, very good morning to you. What do you like about this business?
It's a high-quality, family-owned business. It's about 80% of their activities are in the UK and Ireland, 10% in Europe and 10% in Australia. It's really a sizable business in light catering equipment and heavy equipment. Size matters. We do have some businesses in this field around the world, and a big part of what they do is also own brand sales. And it's one of our strategic pillars to continue to build our digital progress and also our own brands, and that fits perfectly with the Nisbet acquisition.
Now, Bunzl's always been a very acquisitive business. I think you did 19 last year alone.
Right.
But this is quite big by your standards. Is there an execution risk here?
Not really. It's let's say it is the largest deal so far in Bunzl history, but our size is obviously getting bigger as well. Our net debt to EBITDA is relatively low, so our balance sheet is very strong. And I always said, it's great to have a strong balance sheet. It gives optionality, and at this point in time, we were able to pick up Nisbets, which is a great business. Family Nisbets continues to hold 20%, so they're really excited to continue to build the business with Bunzl, and at some point in the future we'll take over the remaining 20%.
And of course, this is the classic way that Bunzl operates. You like the owners and founders to stay on board for a while, and indeed it's how you joined the business yourself all these years ago.
Yeah, it was 1994 when I sold our family-owned business, started and built by my father-in-law. And it's been an incredible journey. I could never have dreamed in 1994 that one day I would be chief executive. And this year it's already 8 years, so time flies.
Really? Well, that's already longer than the FTSE average, so you must be doing something right.
Yeah, no, I think probably my board would agree with me, but it's an exciting business. We have wonderful people. Like, with the Nisbets acquisition, we actually signed the deal at 5 o'clock last night, and our corporate development director, Andrew Mooney, and Suzanne Jeffries, our company secretary, have done a wonderful job with the whole team to land this deal, because these things don't happen, without any effort.
Absolutely. Now, what about the results? I mean, your sales went slightly backwards. That looks to be events in the United States.
Yeah, I think you really need to look at this in perspective. If you look at our profit and earnings per share since 2019 have been up by 46%. So we really had a very strong period. We did see some COVID normalization. More recently, we've been splitting out COVID products from the base business that was more around masks and sanitizing and gloves. But what we've seen also coming out of COVID, that for instance, the consumption of meal packaging, so people were picking up meals from the restaurant or the restaurants were delivering it to the homes. You know, that packaging sales came down and normalized post-COVID. And because when you go into a restaurant, you use a napkin or you go to the toilet and the consumption per person is a bit lower. So there was sort of a broader COVID impact. But, you know, there's nothing fundamentally wrong there. We're, you know, very optimistic about, you know, our margins, our own brand strategy, and, you know, a lot of confidence in the US business.
Yeah, you mentioned that margins may be a little lighter this year. Is that just the business mix that you've just discussed?
Yeah, it's interesting because when I talk to analysts and people, I think there's a bit of a misunderstanding around this topic. When I started in 2016, the operating margins were about 6.6%. Last year it was 8%, coming from 7.4% the year before. So a 60 basis point increase. And we're, you know, and that 8% is basically a beat against our forecast consensus, about 7.8%. We're actually planning to do a bit better than we said in last December. So it's a bit out of context, but, you know, overall margin strong. Also due to our margin management in the business, but also the growth of our own brand and the fact that we're buying higher margin businesses, acquisitions. And you set a record 19 acquisitions last year. We started with Palmark in Finland, an acquisition with Nisbets. So, you know, if we continue like this, we may be looking at a new acquisition record this year, Ian.
Wow, extraordinary. Very briefly, Frank, what about inflation? Are you starting to see it abate?
We've seen sort of a normalization of inflation levels over last year, a slight deflation last year during Q4 in North America. But if I look at pricing going forward, probably a more stable inflation-deflation level. Certain product groups inflating a bit, other product groups deflating a bit. But overall, I don't think we will see so much hectics around pricing going forward.
OK, busy day for your results day, Frank, and especially today. We do appreciate you joining us. Thank you.
Thank you.
That's it from me. I'm back at 4:30 this afternoon. Hope to see you then. Stay tuned. Up next, it's Jane Secker. Cheerio.